the Federal Reserve stated it would close its pandemic period bond purchases in March and pave the way for 3/4 percentage point interest rate hikes by the end of 2022 as the economy nears full employment and the U.S. Central Bank copes with a wave of inflation. In today's video, we'll discuss how Fed rate hikes could impact global markets. But before that, make sure you press that red subscribe button along with that tiny bell icon to get updated every time we post new videos. Let's get started. Markets are expecting the Fed will speed up the wind down of its bond buying program, altering the end date to March from June. That would free the central bank to start raising interest rates from zero, and Fed officers are anticipated to release a new prediction showing 2 to 3 interest rate hikes in 2022 and another 3 to 4 in 2023. Previously, there had been no agreement for a rate hike in 2022. However, half of the Fed officers expected at least one. One of the ways the Fed achieves full employment and stable prices is by setting its inflation target rate at 2%. In 2011, the Fed officially adopted a 2% yearly increase in the price index for personal consumption expenditures as its target. In other words, as the inflation component of the index rises, it signals that the prices of goods are rising in the economy. However, salaries are not growing, people's buying power is declining if prices are rising. Inflation also impacts investors. For example, if an investor is holding a fixed-rate bond paying 3% and inflation rises to 2%, the investor is only earning 1 in real terms. When the economy is weak, inflation falls since there is lower demand for goods to push up prices. Again, when the economy is strong, rising salaries increase spending, which can spur high prices. Keeping inflation at a growth rate of 2% helps the economy grow at a steady pace and allows stipend to naturally rise. Adjustments to the federal funds rate can also affect inflation in the United States. When the Fed increases interest rates, it encourages people to save more and spend less, reducing inflationary pressures. Again, when the economy is in a recession or growing too sluggishly and the Fed reduces interest rates, it stimulates spending, prodding inflation. Despite the ways in which U.S. interest rates negatively impact the global economy, rising interest rates do benefit foreign trade. The stronger dollar that will accompany the rate increase should boost U.S. demand for products around the world, increasing commercial gains for domestic and foreign companies likewise. Because fluctuations in the stock market reflect beliefs about whether industries grow or contract, the performing profit spikes will lead to stock market will rallies. Interest rates are fundamental indicators of an economy's growth. In the U.S., the Federal Reserve's move to increase interest rates is expected to spur growth and exuberance on the part of investors, while tempering the economy itself. Higher interest rates can help an economy avoid overproduction traps and asset bubbles fueled by cheap debt. While the Fed's primary concern is the U.S. economy, it'll also be paying close attention to the effect its rate increase will have on foreign trade and on the world's credit and commodities markets. So that's all for today's video. Let us know your views in the comments section below. And don't forget to like this video before leaving. Thanks for watching.